Rahul Jain, Head India Equity Research and Asia Financials at Goldman Sachs, speaking about a very interesting report that they have put out on the banking space. And this is something that is also in focus, especially with so much happening, good set of numbers which have come in as well. Rahul, great to have you on the show. Thank you so much for speaking with us. Is it time to start looking at PSUs? I'm starting with a not so obvious question because, yes, private banks have been in focus. Everyone's loving what they have put out, save an Axis Bank, but everyone else largely. Is it time now to look at PSUs?
Thank you, Tamanna, and good to be on your show. So look, I mean, before I specifically delve into your question, let me just paint a broader picture of what we are communicating to our investors. Clearly, I think the setup looks favorable for the banking space overall. We've seen slew of policy measures from both the regulators as well as the Reserve Bank of India. And that actually has led to sharp reduction in the deposit cost for the banking names. So clearly from where we are, we clearly see a V-shaped recovery playing out in the margins in the second half for most of the banking names out there. We will have peaking of the credit cost, which has been elevated even now for some of the players. Second half should trend better. And therefore, the EPS cuts the sector was witnessing till about last year should start to moderate. And the first quarter was one such quarter where the thesis got validated and has given us more confidence that second half onwards, the recovery should be buoyant. And getting into fiscal 27 actually could be very strong for the banking space overall. So that's a broad view on the space. There is one question that is out there that investors have been raising is on the credit growth. I think that is a big question to deal with. Right now, it's a phase of consolidation that we are going through. We will see a recovery most likely in the second half again of this financial year, running into fiscal 27, as the households come out to borrow more and to spend more, and that should actually provide more support to the earnings growth overall. Having said that, there are competitive headwinds out there. So your question about the PSUs, whether it makes sense to look at them right now, typically what we've seen is the drivers of PSUs are very clear, the visibility on their core ROAs, which is going to, in our opinion, face some challenges because of the sharper rate cuts that we are seeing on the lending side, plus the liquidity glut in the money markets, which are pulling down the rates over there. So if you see the gap between the rates that PSUs charge, they will need to bring down a lot more, and that could mean the ROAs would remain under question mark, and investors don't tend to like the setup where the ROAs are moderating, particularly in a deep rate cut cycle where the competition is also abound. Last point over there is when you got to look at the valuation, what you're paying for to buy the the core ROA trajectory, and that seems to be full at this point of time. So we don't have a strong favorable view on the PSU banks.
Okay, long story short, no strong favorable view in the PSU banks. But what about the whole space? Are the large private banks really pulling their weight this quarter?
Indeed so. I think if you see in this quarter, the key focus was on the core operating profitability, which was well managed, even though we had the NIM declines, which was factored in by the market, because if you see point to point from the rate hikes to now the rate cuts, there's still the banking system has gained on the margins front. So in this quarter we felt that the NIM trajectory was well managed by the sector, and that has given us the confidence getting to third quarter. You'll actually have a sharper recovery in the margins to play out. One important factor to also note is the private banks and even the select NBFCs have a reasonably well-diversified loan book mix. And as and when the consumer lending picks up, driven by the unsecured loans, that will also support the margins. And that is something that the market is going to like as and when the visibility of that starts to come up. So to answer your question, yes, I think the trends are looking quite favorable as we stand today.
Rahul, good morning, Neeraj here. There is, when I speak to fund managers about whether they would want a higher positioning on NBFCs because of the RBI actions and the rate cuts versus banks, there are contrary opinions coming in, wherein some people who look at it maybe 12 months, 18 months, 24 months out believe that the transition is over a 6-month period and then it's business as usual. And therefore, if you're thinking of 6 months, yes, maybe NBFCs, but if you're thinking of 2 years, then maybe banks. How do you think about this particular question?
I think, thank you, Neeraj. And look, the answer really is you got to be bottoms up. I think wherever you have the earnings visibility driven by the core operating profitability is the mantra that we follow. And that's what we are advising our investors to follow as well. And there, some of the points that I was telling Tamanna about are going to be the ones that market is going to focus on getting into the second half and the next year. But to answer specifically on the debate between the NBFCs and the private banks or the broader banks, clearly right now NBFCs have managed their NIMs better, mainly because their linkage to the external benchmark rates is much lower in the overall portfolio. But come second half when the deposit will start to get repriced, and the private banks this time around have been quite nimble-footed to even reduce the rates on savings deposit, which has not been very frequently seen in the past. That should give investors the confidence that they are very, very clear on protecting the profitability. So from second half, as the term deposits start to get repriced, I think you will see expansion of margins and the PPOP growth accelerating for the private banks. So clearly you will see some of the flavor shifting back to the private banks predominantly because of that. But having said that, if you're taking a view on 12 to 18 months, I think the earnings growth will become quite important to focus on, particularly the core operating profits. And there, I think the gap reduces over that time frame between the private banks and the NBFCs. And look, NBFCs also trade at an expensive valuation than the private banks, so to speak. So there are pockets of opportunities. So it's time to be more stock specific than be more, broad-based macro, taking a macro view on the sector per se.
Okay, but it's a very wide bucket. I'm wondering, one, if you are at a liberty to talk about what your pecking order is, and if not, at least the buckets within, let's say, the NBFC space, right? Because there are, or within the financial space, there are lending financials, non-lending financials, and I presume maybe you're covering both. But if not, even if just within the lending financials, gold lenders, smaller lenders which are trading at a really good valuation, but probably don't have the agility and the size of the balance sheet versus the larger ones. How do you kind of narrow it down?
Great question, Neeraj. So look, the answer really lies in there, what you just talked about. I think you need to focus on the cadence of growth, particularly in the operating profit growth, because growth without profitability would not really get you the valuation that you aspire for or the market's attention. So we are really focusing on the bottoms up, even if that means the company is in the housing finance space or it's a diversified lender. So long as they have the ability to retain the market share or to expand the market share and protect the profitability in this otherwise competitive environment, those companies would make returns for the investors is the basic philosophy we are following. And that's again, a basis what we just talked about. I think in terms of pockets, what we've said to our investors and what we're talking about is consumer should start to pick up momentum getting into the second half. The signs are quite visible. The signals are very clear. And the portfolios have been by and large cleaned up. There are impetus stimulus provided by the government as well as the Reserve Bank of India in terms of the rate cuts, which is helping the households' disposable income. So that should come back. Whereas the commercial retail segment, like commercial vehicles, business banking, etc., would be a derivative of this. If the consumption picks up, the second stage of pickup would likely be seen in the commercial retail segments. So that's the broader space we focus on. But look, bottom line is how much growth you're getting in each of these companies, and that's what the market is going to focus on.
Last point on your list of preferences, I think Axis Bank tops the list. After this whole thing about technical provisioning, etc., are you retaining that call?
So look, I'll avoid the stock specific, would go back to the points I was making earlier. I think we clearly see the cycle will start to become favorable in the next quarter or two. And any lender who has got a strong provision coverage ratio and balance sheet is well protected, they will enter into a benign cycle that will see ROE expansion and growth momentum picking up. And then, in conjunction with that, what valuation you're willing to pay to those names is what the investors will need to focus on. So really speaking, that's where, we would focus on, irrespective of the names. And that is very, very consistent across the coverage companies that we are highlighting to the investors to buy into.
Okay. Thank you so much for that. Rahul Jain there of Goldman Sachs, going strong on banks and private banks still leading the charge.